There we go. Hi, everyone. Thank you for joining us today. We are going to be learning about charitable donations and charity tax strategies, which is a group of creates the opportunity for wealthy clients to support the charitable causes they really care about and save some taxes at the same time. This is an area of the industry that a lot of people or a lot of clients are looking for the right advice and the right support. Many wealthy clients do care a lot about education or humanitarian causes. Some like to support healthcare, disease, or even sports and sports in their community. Maybe it's hospitals that they're looking to donate to. It's a lot of different causes that clients can be interested in. And at the same time, they're looking to support these causes on a tax advantage basis or in a way that allows them to give more money to the charities by reducing their tax burden. So we have a couple strategies that Michael's going to be going through and Weston. So thank you for joining us today, and I'll turn it over to Michael to get started.
Thank you, Corey. All right, so I'm going to start off with a sample example. So meet Addison, and she owned a $1 million permanent life insurance policy with a cash surrender value of 120,000 and an ACB of 80,000. Now, Addison herself no longer needed this policy for estate planning. Okay, whether her financial situation changed, she can't afford it, doesn't want it anymore, whatever the case may be, she decided that she basically doesn't need this policy. So she has a few options. One, as you know, she could, of course, just liquidate it, cash it out. That would trigger taxes based on this scenario. There's the CSV is higher than the ACB, so she's going to pay some tax. The other option is going to be to donate the policy. And this is one of those things that is not well talked about. It's kind of like a best kept hidden secret, so to speak. But I'm going to walk you through what would happen if she didn't cash it out and if she did actually donate the policy. So the donation strategy would be this. So instead of surrendering, she can trigger about $20,000 in tax. Addison would donate it to her favorite charity, and she would receive a tax receipt for, in this example, $400,000, which is the policy's fair market value. And I'll explain how you get to that. But just at the screen right now. So she just avoided a $20,000 tax hit, and instead she's going to receive a tax receipt for $400,000, which is going to save her approximately $200,000 in taxes. So obviously, far more advantageous to Addison. Now, the key takeaways. So basically, if you can donate instead of surrendering, there's a huge potential for greater tax benefits. The policy has to be owned typically for 3 years to avoid CRA restrictions. So you can't get a policy kind of tomorrow and do it the next day. There's got to be a 3-year ownership. There is an actuarial valuation required, and that's how Addison got to the $400,000 fair market valuation. So you can't, like, as an advisor, we can't just necessarily decide. It has to go through a formal valuation. And I mean, typically it is kind of best suited for larger charities that can fund the future premium. So I'll explain the kind of the mechanics behind it. Eligible policy type. So this works for term or permanent, whether it's whole life or universal. They're both eligible for the donation. Typically, whether there's medical or actuarial underwriting costs, the foundation would most likely pick up the tab for both. The selection criteria. So as I said, policy has to be active for at least 3 years. Typically, the face value needs to be 50,000 or more. Usually, it might even be 100,000 or more. So you can't do this with like micro small policies. A huge benefit is, as well as the foundation is going to assume responsibility for the payments. So the client no longer makes the payments. It's the charity itself that will make future payments. And the ownership and beneficiary is, of course, going to be the foundation or the charity. So they're going to become both the owner and the beneficiary of the policy. So when the individual passes, their family or corporation or anything is not going to receive anything. They are literally donating the policy to the charity, and it's in its literal sense. Now, what's in it for the donor? Huge thing. So there's like I said, a potential for a very large tax receipt, which is typically anywhere from 10 to 50% of the policy's face value. Again, has to be done through an actuarial valuation, though. You can turn essentially, a lower no cash value policy to a potentially good tax benefit for the client themselves, no more premiums, and the tax benefit is usable against all income, including RSP and RIF withdrawals. So it is a very effective tax planning opportunity for the right client. It doesn't impact OAS, and you can claim it for current year plus five. So depending on the size of the benefit, more than likely the client would be able to use it. And I think, aside from kind of the financial benefits, creating a medical legacy, as Corey mentioned at the beginning, any client that wants to basically leave behind something, this is a fantastic opportunity for them to do so if they fit this kind of client profile. So ideal candidate. So really, it's someone who has some sort of a life insurance policy with no longer that need, whatever that need is. Maybe they can no longer afford it, or they want to reduce the coverage or donate some sort of an unwanted portion. So they, as far as like age demographics, it doesn't really matter in a sense. It's more so they have a policy and for some reason they want to reduce it or get rid of it, or they don't want to pay for it anymore. And it makes sense after going through this whole process that a donation of the policy is, in the client's best interest and the charity's best interest. The process of donating a policy. So there are multiple steps. So number one, of course, kind of just like initial info submission where you would speak with the charity and gather the basic info of the client and the policy summary. There's going to be basically a telehealth interview questionnaire with the client themselves. And so one of the things they determine is basically how healthy the client is. And the way it works is the more either unhealthy or closer they are to basically passing away, there's a chance that the fair market value is actually going to be higher. There's a medical evaluation, so the client gives consent for the evaluator to access their medical records. They're going to draft basically the estimate of the fair market value for the tax receipt, and if agreed on, basically there's a change of ownership of policy, and all the documents are signed. So this can be done. It's not a week. Like it's going to take probably maybe a month or two or something like that. Like it's not going to take 6 months, hopefully not. But it's not like an overnight thing. Bit of a process, but it can be done efficiently. Now, there's a big benefit for term policy as well. So they can possibly get basically a fair market valuation that may even be higher than the actual cost of what you've paid for the policy. So just keep that in mind. If they only have a term policy, it still can be very beneficial. After the donation, the charity pays the premiums. Donor receives a large tax credit good for 6 years, which is current year plus five. No further financial responsibility. The advisor also stays on the case. So this is important to know. You're not necessarily losing the policy. You're just, the ownership is changing to the charity. And most likely the charity would cover the underwriting and valuation costs themselves. Now, items to consider. So the first one is when the policy is donated, it still is treated as a disposition. So depending on basically the fair market value compared to the ACB, you just want to make sure that if there is a capital gain or like a taxable transaction, the client's aware of that. It just can't necessarily just be done completely tax-free. It just depends on the value of the policy. It also, so the change of ownership may limit the client to get future insurance depending on their insurability and how, like, their limits basically. So they technically still are the life insured. So just let the client know that if they're giving up a large policy, they just got to make sure that if they do want future insurance, to consider the fact that the insurance company is going to look at their collective insurance policies when making that decision. And then, of course, there's going to be a consent to allow access to medical records, which probably should be too much of a big deal considering what the client wants to do with this. But those are just one and two, I would say, are the most important. But this is something that it won't apply to everybody, of course, but for the person that it does apply to, you're going to seem like basically like a financial god because they've never heard this before. People have never heard this strategy before. And when they are fearful and frustrated that they're going to lose a life insurance policy, they've been paying for it for years, and they can't afford it or whatever the case may be, they get frustrated that they're going to lose kind of like quote unquote all the money they put into it, especially if it's a term policy, or they're going to have to pay tax if it's a whole life and they're kind of liquidating it. You're a hero in their eyes if you present this to them, and they're the type of person that want to go through with this. So I would always bring this up, whether they do it now or in the future, or they tell a friend. This is a very, very good thing to do. And it really shows your empathy as an advisor and separates you from the rest, where there's a true care for what you're doing. And this is like very much win-win, where the client wins, the charity wins, and it's not overly complicated. So just keep that in mind. That is it for me today, and I'm going to pass it off to Weston.
Thanks, Mike. Just to echo Mike's points there, you can't overstate actually how good this approach actually works with clients that have been in an insurance policy or a specific insurance strategy for a while, and for whatever reason they can't continue with it. When you can show them something like this, yeah, it really elevates you quite substantially in their eyes. And when you're able to get them a win on what they otherwise thought was going to be a major loss, being able to do that for them really goes a long way. So I'm going to go a little further into the overall charitable giving in Canada, some of the different strategies that are available in that regard. So some of these will touch on insurance strategies. Some of them are just more basic. And the idea is just to let you know what is available out there. And if charitable giving is a strategy that is of interest to clients, being able to show a broader context of understanding the overall space and what's available gives clients more comfort, obviously, than just giving them one strategy. Here's how you can do your charitable giving. When you can give them options, again, it makes you a more trusted advisor for them. So just move on. Typical disclaimer. Again, that none of this is tax advice or investment advice. We would want to consult with professionals, their professional team at all times with that. When we look at this, what are the charitable gift options available? Cash is obviously the most straightforward one, but it's always not the best. There's multiple gifts in kind that can be given as charitable gifting: tangible property, publicly traded securities, seg funds, or certified Canadian cultural ecological property. You can donate registered plans, RSPs, things along that kind of lines. There's bequests through wills, charitable remainder trusts, insurance policies, and charitable gift annuities. So we'll touch on each of these fairly briefly. I'm not going to go super in depth into them, but give you some idea of why not you might want to use one strategy over the other depending upon a client's specific situation. So a cash donation is a really simple and effective method for giving. Advantages for the donor: there's no cost to donate. It's there's no ongoing obligation. It's completely at the donor's discretion, and the donation receipts can be used in the current year or carried forward. For the charity, they get the money right away. It's liquid; they can use it as they need to, and so forth, which is good. The drawbacks on it: it's not always the most tax advantage way to do it. There can be some other options. It lowers your current income and savings. That may limit the amount of the donation, so you may not be able to give as much money as you'd like to, or to have a more meaningful impact. And again, once the charity has the money, your ability to influence how that money is used is really quite limited, if any at all, in that regard. Which may not be depending on the size of the donation, may or may not be attractive for the donor. So again, a planned approach may be appropriate for larger donations and a lasting legacy. Gifts in kind, tangible assets, they can't be a service. Creates a deemed disposition, could be capital gains and so forth that are associated with. You may need an appraisal in that regard, and some additional costs and time. And the other thing is, can the charity even accept the gift? Maybe it's not appropriate for what they need or are able to use, and so forth. Gifts in kind, there are some special rules that play out in this. If you're using publicly traded securities and segregated funds, the benefit of that is that it does reduce any capital gains to zero. I'll show you a quick example of that, which can make this very attractive if you have public, stocks or bonds or seg funds that have a very high deferred capital gains on them at this point. And Canadian cultural ecological property, again, no capital gains on those, and that has some additional tax benefits from that side. just to see how it works, just kind of the side by side. If somebody had $100,000 market value of cash or shares to donate, if they were going to donate the cash on the left hand side, the ACB's at 40,000. They have a capital gain of 60. The taxable capital gain would be 30,000 in the case of the cash, but there's no capital gain associated with the donation of the shares. So when in the case of the cash, there'd be about 13,800 of taxes would be taxable. So your next tax savings on the gift is about 46,000. Sorry, the taxable savings on the gift is 46,000 minus the capital gains means you're giving about 32. Where if you donated the shares, the difference is about 13,000, almost $14,000 difference. So that can be pretty meaningful, again, depending upon the extent of the capital gain that's associated with those shares at this point, to donate those as opposed to say cashing out and then paying a donation in cash. Registered plans. So, you can name a charity as a beneficiary for your registered plans. It does bypass a state, so it doesn't go through probate, which can be attractive for many high net worth people. Don't necessarily want their information out there for public consumption, which happens once any of this type of stuff does hit probate. Donation limit increases to 100% in year of death and preceding year. Donation receipt used to offset income for your RSP or RIF for your registered account. So you can also, in this case, if somebody really does want to register donate the registered plan, there is solutions to use insurance to replace that capital otherwise. Again, it's just a different approach to it and another opportunity that might be there that, hey, I want to donate my registered plan, but hey, how do we replace that cash for personal use or for other things? Using insurance might be a way to do that. Again, just a quick side-by-side on how that works. If you had the donation or without the donation, so in the left-hand column, 200,000 your RSPs, you donate the full 200,000. There's an 86,000 at 43% taxable income. The tax savings from the donation is comparable. So your tax cost at the end of the day is zero, and the charity gets the full 200,000. Where again, if you were to cash that out of the RSP through a registered plan, there's going to be the taxes are fully applicable, and there's a significant drop in the amount of money that's actually going to be donated to the charity at that point. Bequests. So again, this is declaring a donation through your will, and this is it's been a traditional method for a long time. For some people, they like to do it this way. The benefits of it, you can get the name of charity in the will. You can that can be changed up obviously until the person passes away. There's flexibility there, and they can make whatever designations they want as to the amount and so forth. The downside, it can be challenged. It could be subject to creditors, subject to legal and estate administration and probate fees. And as I mentioned before, it's probated. It's in the will, so it becomes a public document. So that's available for anybody to see. Where again, if you have somebody that privacy concerns are something that they want to keep to themselves, this may not be the best way to go about it. There's ways to avoid having this show up in the probate. Tips. Ensure there's enough money to get the maximum benefit. Again, if there's taxation or creditors that may chew into that, if there's not enough cash available in the overall estate to manage that, you got to have very clear instructions in the will. Often we've seen wills just lack clarity or complete instructions, and they can be challenged and in some cases overturned. Another point being is that if the money is being sent by the executor as a gift on behalf of the estate instead of a bequest, that can add challenges. And depending upon when the will was created and the bequest was done, is the charity even still in existence? In some cases, we've seen where the charity is now gone. Well, the client was passed on as well. what were the wishes for that money at that point? Was there something else they wanted to do with it, or so forth? So again, it comes down to having a really well written will, and trying to account for all the different contingencies that may occur in that regard. Charitable remainder trusts. This is another one where you take the client takes the money or the asset, places in a trust, uses the income from the trust, and then whatever's remaining essentially at the end is what's going to go over to the charity at the end of the day. There's some real benefits to that. Donor retains income from property during the lifetime. It's there's immediate receipt based on residual value. And donor retains control and use of the property during their lifetime, as long as they're controlling the trust. Downside of it, there's cost to doing that. It's irrevocable once it's in place, so they can't make adjustments in the future if they need to. There are limited types of investments that you can use. Residual value can't be determined on market-based funds because the value is going to go up and down, and capital gains must remain in the trust, which can create some tax issues, as trusts are taxed at the highest marginal tax bracket. Donating life insurance, during the you can do it a couple different ways. One, during your lifetime, and then in this particular strategy, the charity becomes the owner and beneficiary of the contract. The donor pays the premiums and receives a receipt. On death, the charity receives the proceeds. So there's a couple different ways to donate life insurance policies. So in this particular case, the donor is getting the tax benefit based upon the premiums paid while they're still alive. So for some people, that's an attractive approach to use. For other people, it's upon death. So they name the charity as the beneficiary of the policy. There's no donation receipt for the premiums paid, but the donation receipt is received on death, and that's applied against the estate. So this is just two different ways that you can donate life insurance policies as well. These are a little more common than the strategy that Mike was presenting earlier, but these are still very viable and can be attractive for specific clients. Another one is a charitable annuity. This is a pretty interesting one. Annuities are done through insurance companies, so again, can be very, very attractive from that standpoint. Gift that gives back. A charitable annuity is a way of making a gift, in return getting back a guaranteed income for life that can be largely or entirely tax-free, depending upon how it's set up. So to set up the charitable annuity, the donor donates a sum to the charity issues an annuity itself, or buys an annuity, which is more common depending upon the size of the charity, and the donor receives the payments from that annuity. The difference between the donor deposits and the annuity cost is what's available to the charity. So the important thing here is that whatever the donation is, the charity probably doesn't buy an annuity for the full amount of the money. They keep a portion for themselves, and then the balance is what's used to purchase the annuity and create an income for the donor. So the charity issues a receipt for a difference between those amounts, and the donor is taxed on the interest portion of each payment, if any. Again, annuities are depending how you set them up and how they're run. They can be very tax efficient or tax free, depending upon how they're allocated. Pros, again, maybe no taxable portion on the income. So if you have older clients, there's no impact on it. No impact on their OAS. Creates guaranteed income for life or for a specific term, depending again what type of annuity it is, lifetime annuity or a term annuity. The charity retains a minimum of 20% of the donation, and the donor receives an immediate tax receipt. Allows donor to give during their lifetime, which is, again, they get to see, potentially see the impact of their gift, which is great. It is irrevocable, which is again, depending upon, for some clients that might be attractive, for others it might not be. Just comes down to the client preference, and it's best for clients that are over the age of 70. And again, it does create a potentially tax-free annuity at that point for the client. Just a quick alternative method to do it is you purchase a prescribed annuity and make a cash donation. the big thing here is that there's no concern that gift is disqualified if it's advantage to the donor, and can name a beneficiary on the annuity as well. So cons, it's irrevocable. Just some other rules just to be aware of. Again, we're coming on 10 years on these, so they're not necessarily quote unquote new, but I know some folks that are not aware of these yet, or just were never aware of them. Gifts made by will, direct designation, or estate are deemed to be made by a estate at time of property actually transferred to the charity. So that can be a really important distinction from a tax standpoint and from the estate standpoint. So it's good to know that. If a estate is a graduated rate estate at time of donation, they may claim a donation if tax year of estate that donation is made, an earlier tax year of estate, or the last 2 years of the deceased. Estate graduated estate rules, not GRE, not no rules for claiming donations. Year of gift and 5-year carry forward, 10 years for ecological gifts, and no distinction for tax between gift by will or gift by estate. So that's again, those can be important factors depending upon the client's estate goals and wishes and how they're set up. So those are things, it's nice to know those so that if or when, you're talking with the lawyer or the accountant, just to be aware of those gives you some knowledge in those discussions with those professionals. So who are these types of strategies for, right? High net worth individuals, obviously, that want to leave some kind of a legacy or optimize their tax benefits. Business owners often fall into that same category. It could line up with their philanthropic or company's missions and offset taxable income. Retirees who have more money than they expect to use and want to give back, reduce tax estates, pass on values to their heirs. Families or dynasties, so multi-generational. This is becoming more and more center stage. How do we effectively pass money on to our kids and so forth, and or show them, a legacy of giving in the family, and through doing these types of strategies, help them to understand how you can have a positive impact and create a lasting legacy for your family, and the organizations that they want to support. Corporate executives, again, more high income piece. It may line up with their company's social responsibility efforts with charitable goals. Nonprofit board members. This is an interesting one. I don't know if anybody's sat on a board. I've sat on a few in my time. Often the board members are very, they're there because they're not getting paid, but they're very active and they want to have a good impact on the charity. This is just one more way that they can potentially have a really positive financial impact for a charity that they may have worked with over time. Young professionals, these things are becoming more and more conscious for younger groups, especially if they're making a good income when coming out of school or starting a business and that kind of stuff. Estate planners, obviously, if you can find some estate planners that you work with closely, being able to talk, cognizantly about these types of strategies is really powerful for them. And philanthropic newcomers, again, if you have new Canadians that want to have an impact and want to give back to the community and so forth, this can be a great way to help show them how to do that in a really tax efficient and effective way. Goals: support a cause, maximize their impact, the tax benefits, obviously, building a legacy, community engagement, as I mentioned, personal fulfillment, corporate responsibility, and encourage others. As I said, this one is becoming more and more, actually, I've seen this in a number of families be more and more prevalent, that they want to, lead by example with their family members. Flexibility, they want to maintain control over how and when their funds are distributed, such as through donor advised funds or planned giving. They just want to be able to direct how their cash is being used when they're no longer around. And transparency, just want to make sure that they're working with the reputable organizations and clear accountability, and not, you know, that's the other big one, is a lot of money going to say oversight, with not a lot of money actually going to the end people that really need it, in that regard. So covered a lot there. Hopefully that gives you some ideas. As Mike talked about, that policy donation up front can be a really powerful piece. So I recommend trying to understand that as best as possible, and talk about that. If you see anybody that does have a life insurance policy, significant life insurance policy that may become challenging for them in the future or something along that kind of lines, always having that in your back pocket can really be a game changer in how the client views you as their insurance professional.
All right. Thank you very much, Michael and Weston, for presenting. That was a lot of great information. And thank you to the attendees or those watching the recording for joining us. I hope you learned something that will help your practice, and feel free to reach out to Weston, Michael, or myself if you have any questions or have some clients that might be a fit for some of these strategies. Thank you.